Welcome, everyone. I'm Angelo Robles. I'm the founder of Family Office Association and the host of the Angelo Robles podcast. Today, we're featuring Investment Titan on successfully investing in energy infrastructure, MLPs, and carbon credits. Honestly, so much more. It features Jim Murchie, co-founder of Energy Income Partners, known as EIP. And I would like to give a little bit of a shout out before we begin. I'd like to very much thank our great friends at Accordia Group, our newest partner, sponsor, and collaborator, who really helped make the introduction to Jim and put this, what I know is going to be a great conversation together. We took the theme for today's discussion with Jim about profiting from the planned and unintended consequences of decarbonization from their innovative work with the Ruby ESG and carbon credit portfolio platform. And that is noted on our collaborative post on our Family Office Association website under Accordia as Decarbonization Blind Spot. We encourage you to learn more about them and thank Accordia very much for putting this together. Jim, pardon that long intro. How are you?
Good, thanks. Thanks for having me, Angela.
Really excited. Let's get right to it. We hear a lot about energy transition. We see a lot of funds coming out that seek to profit from this theme. From your perspective, what exactly is energy transition?
So we're amateur historians by nature. We always try to understand how we got to where we are or understand where we are by how we got here. And so when you look at the numbers of primary energy, and which is sort of the energy that you start with, like crude oil and coal and nuclear and natural gas. Going back over 200 years, you can see that system has been transitioning ever since we went from just burning wood to burning coal, and then we added in oil, and then we added in natural gas, and then we added in nuclear. And only recently we've added in renewables, wind and solar that have any size. And so, like all industries, the energy industry has been transitioning from its beginning, and market share goes to the companies that are producing products that have lower cost and better performance. It's like every other product, and technology drives that, and consumers in energy want obviously low cost, but they want their energy to be clean, they want it to be reliable, and they want it to be safe. And so those changes those are sort of the metrics people should keep in mind as we talk about the energy transition going forward. More recently, obviously, the falling costs of wind and solar and batteries have made them competitive. And so they are finding their way into the electric power system. But one of the things that people forget is we've had a huge transition in the United States in terms of the cost of natural gas. And natural gas is cheap because we have tapped shale. And the reason shale is important is that is where hydrocarbons are formed. So think of river deltas, which is, every year you have a flood, and that's why shale is flaky. It's like the rings of a tree. But river deltas are where all the plants and animals are. And when they die, they rot, and you get methane, which is natural gas. And then under heat and pressure, and I don't know, about 200 million years, some of those small molecules get put into bigger molecules. That's why geologists call it the source rock, because it is, in effect, the rotting plants and animals. Geologists have known that's where all the oil and gas are. It's just that rock is very difficult to get the oil and gas out of because it is neither porous nor permeable. And figuring out how to fracture that rock is really that was the code they had to break. And they wouldn't have broken it had the United States government not provided huge tax incentives for drilling in those types of formations. And so while the conventional oil industry loves to go on and on about the subsidies that wind, solar, and batteries get, they are forgetting that they themselves have been beneficiaries of tax credits and policies that were originally meant to make the US energy independent. And so in both cases, we have had government intervention that has subsidized certain behavior. And so far in both cases, the results have been a resounding success in that the cost of natural gas is now a fraction of what it was before. We were oscillating really between $8 and $15 prices for natural gas per MCF. And those costs have come down 60 or 70%. And in the last 10 years, the cost of wind, solar, and batteries are down between 70 and 90%. So far, this government intervention in the first case to make us energy independent, and in the second case to take that energy and make it cleaner, has actually resulted in lower costs for the consumer. So far, so good because of how we've done it.
Let's talk about growth. Investors are excited about the growth in renewables, electric vehicles, battery technologies. You hinted at it at the end of your last answer, but what is your view?
So there's a lot of top line growth. People were excited about all the growth for shale. And the nice thing about shale is it provides a recent example of what we're going through now with wind and solar and batteries, electric vehicles, those kinds of things. Technology improvements have lowered those costs, as it did with shale. The question was, how much money did you make buying shale producers? Because, natural gas, oil are cyclical commodities, just like pork bellies and aluminum and copper. And when costs come down because of technological improvements, it lowers the clearing price for that commodity. I mean, Adam Smith wrote about this in Wealth of Nations. This is what drives commodity prices. They cycle around their replacement cost. And so if you're excited about the top line of fuel cell companies and battery companies and wind and solar companies, you got to check the per share earnings, because the top line for shale grew very fast. US grew its oil and gas production by 9% a year for a decade. Before that, it was shrinking at 1% to 2% a year. So that sounds exciting until you realize that when you lower the cost, you lower the price. That means all the equipment that you've invested up until just then is now less competitive or unprofitable, because it was constructed and it was built at a time when margins and prices were higher. So now, as the costs come down, the prices come down, and all of the assets on your balance sheet are now less profitable or unprofitable. And so the fuel cell companies, the battery companies, they all face that. So when you look at fuel cell and battery companies that have been around for a long time, most of those companies are yet to actually turn a profit. So even though they have a rising top line, the per share bottom line is really what people should focus on, and understand that whether the energy is fast growing or slow growing, whether it's clean or dirty, it is a merchant competitive cyclical commodity business. Just understand that's what you're buying into.
Jim, how prevalent is greenwashing? And maybe for those that don't know, what is greenwashing?
There are a lot of fund companies looking to raise assets from this theme, whether it's decarbonization or energy transition. As you know, in some cases, especially in Europe, there are mandates that companies have certain ESG scores, right? And I'm sure your audience knows ESG stands for environmental, social, and governance. And there are now sort of a ESG industrial complex, to sort of borrow the phrase from Eisenhower about the military industrial complex. And they are out there scoring every company on all of these metrics. And to some degree, they are scraping data from the annual reports. We spoke to one company that got a bad ESG score, and they called up the consulting company. I don't remember which it was, but it was MSCI. There's a bunch of them. And they said, why do we get such a bad score? And they said, child trafficking. And they said, we run a natural gas utility in the Midwest. What are you talking about? And they said, well, your ESG report didn't specifically say you were against child trafficking. Now, that's a silly example, but it shows sort of what is behind some of those ESG scores, because we're very early on in this process. If that's what investors are allocating a cord, well, then the fund companies are simply going to come along and do that. JP Morgan came out with an energy transition fund. BlackRock came out with an energy transition fund. We looked at these portfolios, and I think it's one of them or both of them, they had 95% overlap with the S&P 500 on a sector basis. And then we looked stock by stock, and it was 80% overlap with the S&P 500.
It's ridiculous.
And so I've just seen the headlines. I haven't really read about it, but the SEC is opening up. It's not a docket, but kind of opening up an investigation into what greenwashing. Are these folks actually doing what they're saying. So again, thematic investing attracts a lot of assets. There is a lot of growth here in the top line. There is a lot of technological improvement. The question is whether the investors are going to benefit from it.
And a question, well, I'll make a comment to the audience first. I don't know if I'd quite use the word apologize, but I have some rather complex questions. So unlike some of my more one-sentence questions are very quick, some of the upcoming questions are going to be a little bit in-depth and a little bit context-driven. Let's start with one of them now. How does your portfolio invest in companies that provide exposure to both voluntary and compliance carbon markets that bring capital to projects to accelerate global initiatives to reduce emissions of greenhouse gases?
So yeah, so let me just back up and talk a little about what we invest in. And we invest in essentially legal and natural monopolies operating what we call poles and wires and pipes and tanks. I have been in the energy business my entire career. I started with the old Standard Oil Company of Ohio in 1982. It was majority owned by BP, and then they bought out the minority while I was there. From there, 1990, I went to Sanford Bernstein. I was the energy analyst there on the sell side for 5 years. My clients, a bunch of my bigger clients tried to hire me. I went to go work with Julian Robertson at Tiger for a couple of years, and then ran a long short hedge fund for 5 years, and then started EIP up because we got reverse inquiries, because I had been investing in these pipeline and wires companies from the mid 90s when I was at Tiger. And after the internet bubble burst, people were like, I'm kind of interested in real assets, hard assets. I kind of got burned in the vaporware of the internet bubble. Would you think about taking in outside money? That's how we got started. And really all I was trying to do was old-fashioned utility investing. There was a lot of deregulation in a lot of industries in the 1980s and 1990s. It was started mostly by Jimmy Carter. Reagan finished it up. And so that deregulation in the utility space, both pipelines and poles and wires, created a lot of disruption. And there's nothing wrong with the old monopoly utility model. I like collecting the dividends. I like the non-cyclical element of the earnings. They're not economically sensitive because here's how it works. They're cost plus businesses. Their revenues are the sum total of all of their costs, including interest on debt, plus generally today about a 10% return on shareholder equity. And that number used to be higher with higher interest rates, about 13 or 14. Now it's around 10 for state regulated utilities. It's between 10 and 13 for federal regulated utilities. And so our whole approach is to own companies that have stable and growing earnings that support stable and growing dividends, because at the end of the day, your total return is yield and capital appreciation. And you can talk about alpha and beta all you want, and that's fine looking backwards. But if you're saying, how am I going to put my capital to work? You say, all you're going to get is the yield and capital appreciation. And if you're a long-term investor, the only thing that's going to make the capital appreciate is if the per share earnings and dividends are going up. So that's our expertise. It's really, when you look at the profitability in all of the sectors of energy, it's the only type of assets that actually have growing earnings over a long period of time. And so our companies, because they are heavily regulated, earn that allowed rate of return only if they're acting in the public interest. Keep in mind, they have been granted the right of eminent domain to run these poles and wires and natural gas pipelines. You cannot grant someone the right of eminent domain unless they're acting in the public interest, right? I mean, it's not like McDonald's can go and condemn a Burger King, right? And now you could say, well, if that was Wendy's and the food is better, then maybe they are acting in the public interest, right? But, for McDonald's, Burger King, I think the jury is still out on whether the public would be served by that. So these companies need to be responsive to both policy and regulation. As that policy shifts and starts including decarbonization as some of the metrics, well, then the companies get an allowed rate of return for doing that. This is the one place where you can invest and say, investing for social benefit doesn't actually reduce your returns. It actually entitles you, allows you to continue to earn the returns that have been granted a regulated monopoly.
The task force on scaling voluntary carbon markets estimates that the demand in the voluntary market for carbon credits could increase by a factor of 15 or more by 2030 and by a factor of up to 100 by 2050.
Yeah, there are a lot of companies, as you know, whether Google, Facebook, Walmart, they all have clean energy initiatives. Google will be sort of net zero carbon in a few years. It is their belief that their customers expect this of them. The Google has the scale and ability to actually, in effect, sponsor wind and solar farms. Their actions will actually get those projects built because of their scale. In the world of impact investing, that's known as additionality. Their actions are actually adding to the clean assets that are out there. They're having that impact. Smaller companies don't have that ability. So what they're left with is buying clean energy credits from someone who does have the scale to actually put in, say, zero carbon electricity. That then creates a market that others can tap into. And so what will be interesting to see as it evolves is whether these credits will be cross-border. So for example, will you have a clearing price of carbon because of all these voluntary efforts that they gets towards $100 per ton of carbon? And now you have a non-regulated power generator. He's not getting an allowed rate of return. He's a merchant power generator. And he says, you know what? I can do carbon capture and storage off of my coal plant or my natural gas power plant, and I can do that for $75 a ton. And if I can get 100 by selling those credits to a smaller company, doesn't have Google scale, they can't affect these kinds of industrial level investments on their own, then that starts, if I hate to say trickle down, I can't, I'm just not coming up with another phrase, that will help create a market where one doesn't currently exist. I mean, there are pockets of these carbon markets around the world, and people are doing some, even California. People in Iowa can sort of get credits because California offers them. So these markets do get created by this type of activity.
In the energy industry, it's long been conventional wisdom that natural gas will serve as a bridge fuel to low carbon future. Generally, my experience, conventional wisdom in financial markets is wrong, often due to misdirects. Is natural gas a bridge fuel or just a fake ESG play?
I'm not sure it's either one. Natural gas earned its place in the energy stack, and on a global basis, it's about 20 to 25% of all the primary energy used in the world, and that's up from almost zero prior to World War II. Right. It's earned that because of its cost and its performance, and its performance attributes is definitely cleaner, right? I mean, it's you don't have a smell when you heat your house with natural gas, et cetera. So the question is, bridge to what? And you say, well, bridge to zero carbon. And you say, well, how are we actually going to get to zero carbon? I mean, over 80% of our primary energy today in the world is provided by fossil fuels. So the idea that in 30 years, the world is going to be net zero carbon is difficult to imagine. Forget the economics of it. Just say governments all decided that they were going to mandate this and there wasn't any choice. Just the actual physical replacement of that is hard to imagine in 30 years. And so when these dates approach, or in the case of what Joe Biden is suggesting, that we bring zero carbon to the electric power industry back to 2035 rather than 2050 for the whole economy, because 2050 is becoming the date that everyone around the world is targeting. China's 2060. The implication of bringing forward to 2035 zero carbon for our electric power system means that you are stuck with existing technology, because it's 13 years away, 14 at the most. And so you don't have time to develop a new technology, work the bugs out of it, and get it going by 2035. And so one of the technologies that already exists, although the cost needs to come down, is carbon capture and sequestration, utilization or sequestration. And so there is, for example, a company, it's privately held by a company by the name of Eight Rivers. It's run by a guy named Bill Brown. They have one of their portfolio companies is called Net Power, and they have a 50 megawatt pilot test going on in La Porte, Texas. I have seen this. This is a gas turbine that burns pure oxygen. So its effluent is pure water and carbon dioxide, which it then uses under pressure to make the turbine run more efficiently. But you have a pure carbon dioxide exhaust that you can either use in an industrial process or stick back down in the ground where it came from. And their technology is penciling out at a number below the current price of wholesale electricity. In other words, you don't need subsidies to make this thing profitable. And so does that make natural gas a bridge fuel, or does it make it a dispatchable, reliable, resilient, safe, zero carbon source of electricity for the grid? In that case, I'm not sure it's a bridge fuel. I think when people immediately think fossil fuels create the carbon, so let's get rid of the fossil fuels. But if you go back to the 1960s and 70s and the Clean Air Act and the Clean Water Act, we were dumping, I mean, you just ask anyone who lived in Cleveland, Lake Erie was a sewer. And we didn't clean it up by closing every factory. We cleaned it up by having those factories not put into the river what it was that was their effluent. We captured it and we cleaned it up. And what's interesting to me is how few people are talking about that for carbon, although when you look at the infrastructure plan that has bipartisan support, of course, it's being held up by the reconciliation bill and all of these nuances about Washington, which is why everyone hates Washington, because no one understands play by. But there was bipartisan support for that infrastructure bill because it was an all of the above type of approach that includes a lot of support for carbon capture and sequestration, which allows you to use your existing incumbent infrastructure in a way that will be zero carbon. That's what brings the Texas votes along. That's what gets Joe Manchin to vote for it. Remember, he's from West Virginia. He's from a fossil fuel state. That's what gets the two senators from New Mexico who are Democrats voting for. One of the two senators in Montana is a Democrat. So, the majority isn't quite as obvious as people think it is. It's thin to begin with. But when you start thinking about actually getting rid of the carbon, you have to think gigatons. You have to think the existing system, the existing infrastructure. And a lot of what's going to get us to zero carbon is running the existing system and capturing that carbon and sticking it back down on the ground. And I would say we should only be doing that if that is in fact the cheapest, most reliable source. I think all of these things have to compete on their merits. But the merits are, are you zero carbon? Are you zero methane? Are you safe? Or are you reliable? Because all of those metrics matter, as we've seen in Texas and California, and now we're seeing in the UK. The public will not support clean energy if it means the lights are going out all the time.
How can the production of raw materials like lithium, cobalt, nickel be considered green when mining and extracting these often are ruinous to land, water, wildlife, and people?
There's no question. I'm not an expert, but I've read the same articles other people have when you look at what happens to the wastewater runoff in Chile and all that kind of stuff. There's no question that, no matter what humans produce, they disturb the earth to do it, because pretty much, everything that we use is animal, mineral, or vegetable. That's why that's the first question you ask when you play 20 questions, because everything comes from one of those three sources. And so, one way to see, other than services, what humans do is they take raw materials and they convert them into something useful, right? Just look around your office. Everything there started off as a raw material, either as an animal, mineral, or vegetable. And you cannot convert or harvest that raw material without disturbing the earth. And so I think all industries need to address that. And so so this is what people say about natural gas. You say, yeah, it's less carbon, but there's all this methane that leaks along the way that all those leaks have to be stopped, which is true, because methane is somewhere between 25 and 80 times more potent, depending on what time frame you have, as carbon dioxide, pound for pound. There is wastewater that's produced in certain places from the shale, like in Pennsylvania, that comes up with a lot of radiation in it. And the industry isn't addressing that. And so you can't you can't say I'm clean on one side, but be dirty on the other. I think the public needs to hold all these companies to account so that there is an open competition, so that in fact, you bring the product that has the lowest cost, the best performance, and that's performance all the way along the supply chain. And I will, I'll put in a plug here for ESG. I don't think it's completely in any way misguided. I think people really understand that as shareholders, you can have a role in what these companies do. And while the child trafficking example I gave was to sort of show that you can do this the wrong way, obviously no one should be for child trafficking, but this was a gas distribution company in the Midwest. There are issues that these companies have under their control that perhaps the public should be demanding of. So for example, if you're a gas utility in the Midwest, what are you doing to make sure that the people that supply your gas have a clean chain of supply all the way from the wellhead? And so we now have a growing movement in the US called RSG, responsibly sourced gas. Blockchain technology will probably play a role where you could actually tag every molecule of methane when it comes out of the ground and trace it all the way through to its end use to make sure that molecule of methane has gone through a gas producer that is somehow certified with zero or very low emissions, and a pipeline system and a processing system that does the same thing. People are demanding that of fossil fuels because they're kind of under the magnifying glass.
Here's one of my long ones
with lithium. Your supply chain needs to be just as clean as your end product.
Companies in the LNG value chain can reduce greenhouse emissions, I guess, in a number of ways, including using biogas for feedstock, reducing emissions from upstream pipeline and liquefaction facilities, using renewable energy to power the liquefaction facilities, using carbon capture, utilization, and storage. This is a deep one here. Technologies, Cheniere Energy. Is one of your best performing portfolio companies, is it due to green initiatives?
Not so far. I think that will affect the stock going forward because you open up more markets if you can demonstrate that your gas is responsibly sourced. Let's face it, there are people that think fracking is this horrible environmental offense. They don't really quite understand what it is. They don't understand the industry has been fracturing rock for 100 years. They literally used to drop a bomb down the wells in Pennsylvania when they first started drilling for oil over 100 years ago. They dropped the bomb and they'd run. And so we've been fracturing rock to make it more porous and make it more permeable, really, since the oil industry has been getting oil out of the ground. People then associate, drinking water. And it's like, well, the drinking water is generally in the first 200 feet. This gas is being produced 5,000 to 15,000 feet down on the ground. The only connectivity between those levels is the pipe that brings the gas up. And that is why all regulations require that you put a pipe in the ground, you cement it as it goes through that water aquifer, so it can't be, polluted. But whether that gas was fracked down at 15,000 feet or conventionally produced still poses the risk to that drinking water. But there are countries in Europe that they are going to refuse to buy fracked gas. That is obviously, look at what's going on with natural gas prices in Europe today. That is a potential market for Cheniere if they can demonstrate that in fact their gas is more responsibly sourced. I listened to a panel. This was associated with the Aspen Institute, where we participate every year. They have a couple of energy environmental roundtables, and they had as a panel the Democratic senior analyst and the Republican senior analyst on the Congressional Committee on the Climate Crisis. So there is this committee, and what was interesting is these two people, they said they agreed on about 80% of what they worked on. And with the Republican person, it was interesting to see the statistics this guy was carrying around in his head. And he said, the amount of greenhouse gases emitted from a US LNG operation is half of the environmental footprint of what the Russians are producing and delivering to Western Europe by pipeline. So I haven't run the numbers, I haven't seen it, but I wouldn't be surprised if what he's saying is true, because we operate under stricter environmental regulations here than they do in Russia, the old Soviet Union. And so here already is someone on the Republican side of the aisle saying, look, I am for clean energy if it means, everyone's breathing cleaner air, if it's something that what the Americans are already doing gives us an international competitive advantage. It's a national security issue. It's a jobs issue. It's a balance of payments issue. And, it's a sort of international strategic issue. We can push the Russians out of supplying gas to Western Europe, or at least make Western Europe less dependent. And so it's fascinating to sort of see how the different political constituencies are coming along on issues just like what you raise, on this whole clean chain, because on an international basis, what we've done is actually pretty good. It's better standards than most other places.
In order for green LNG to succeed as a tool for achieving ESG objectives, the LNG industry must quickly come together, I would say, to resolve certain issues impeding acceptance of green LNG as a uniform and tradable commodity. This leads me to my following, I suppose, series of questions. How do you think about developing and adopting accepting MRV standards to quantify greenhouse emissions reductions from each part of the LNG value chain?
When you said MRV, what is that?
MRV. Yes, I did an acronym there, but I don't have my definitive valuation.
Yeah. Okay. I'm not sure what that is, but I think this is how industry associations kind of get together, because they all have a common interest. And if even though they're competitors, they sort of pool their resources on these standards, then it's good for all of them because it gets them share on a kind of global basis. So I actually think that's kind of already happening. You actually see there's a number of initiatives in the industry, one specifically on methane, and now you're seeing this on responsibly sourced gas. A person or a small group of people usually comes up with these ideas, and then it grows to get other people in. You have to modify your standards. It's all a negotiation, but eventually you come to a standard. And I always think of organic. I mean, what does organic mean when you buy organic food? Well, now the FDA has like really strict rules on what that word means. But 30 years ago, that wasn't the case. And so, while there's a lot of organic washing, right, in food and cleaning supplies and things like that, the farther this goes, the more standards there are. So it's definitely a positive for these folks to do that. And it's interesting to see sort of which companies are embracing it as a business strategy and which are stiff arming it because they think it's going to go away.
And we thank you, David, from our live participants. I wrote the acronym MRV. It stands for Monitoring, Reporting, and Verification, which your answer was apropos to that. So we kind of put two together. How do you determine which parts of the value chain each participant should take responsibly in terms of upstream and downstream via emissions or emissions associated with a particular energy company?
So a society that depends on voluntary stuff is gonna get just that. As James Madison said, if men were angels, we wouldn't need laws. So we have laws and we have regulations to collectively sort of enforce what the democratic process has collectively decided on. And there are always folks like Google and Facebook who voluntarily do this, and they actually sort of help pave the way for things to come behind them. But scale only happens when society as a whole decides they're going to do this and puts it into a regulation. And I think what I have learned over the years is that cap and trade and market systems work. I don't think there's much debate about that, so long as the market is designed properly and it doesn't sacrifice one element of the product, a performance element, in response to another, maybe say price. But standards also work. And so I would point people to the 2007 Energy Security and Energy Independence and Security Act came out of the Bush 43 administration. This was the legislation that got you LED light bulbs. They did not mandate LED light bulbs. They mandated a 25% increase in the efficiency of conventional light bulbs. Now, there's 15 of the 50 pages of this bill is set to defining what a conventional light bulb is. You don't want to read that unless you're trying to get to sleep. But in effect, there were only two technologies that would do that, and compact fluorescence was one, and LEDs were the other, and everyone hates CFLs because they take 10 minutes to warm up. And so in effect, brought you LED bulbs, but it didn't mandate them. And when you talk to the gentleman who pretty much designed that legislation, who was the head of the Council of Environmental Quality under Bush 43 for all 8 years, he would tell you that you can try carbon taxes and these other things, but there are some things, you couldn't have cap and trade, on efficiency for light bulbs at people's houses. It's not practical. It has to, cap and trade only works at an industrial level. You just put in a mandate, and then it's simply against the law not to meet the mandate, and the industry will figure out the cheapest way to do it. And
get it done.
You get it done. And, I'm going to put a man on the moon and return him safely to Earth inside the decade. I'm not going to tell you how to do it, because I'm just a liberal arts major from Harvard. I mean, my daddy was Secretary of State, and I'm president now because of that. But I'm just going to give you this objective, and you guys, you smart guys, are going to figure out how to do it. And so I think you'll see more of that in the legislative, attempt to address greenhouse gas emissions. You'll see more and more mandates like that, and the good part about that is it allows the industry to come up with the cheapest, most effective solutions rather than mandating those solutions.
How do you establish a transparent system for verifying claimed carbon reductions, including potentially the use of accredited third-party auditors when choosing investments?
Yeah, so I don't know the answer to that question. It is so far kind of down the road. But if you think about who we're investing in, the regulated utilities, any cost associated with that is something that they're allowed to pass along in their rates. If you're a merchant company, if you're Exxon or Chevron or whatever, you always have to justify whether or not the money you spend on that kind of verification of the supply chain upstream of the raw materials you acquire and downstream of the people you sell it to is always something you have to justify to your board of directors is worth the payoff. And that's one of the things I try to remind people of, whether I'm talking to policy people or regulatory people or investors, that the unique position these regulated monopolies afford is that they have essentially unlimited private capital to fund businesses that are in effect public-private partnerships that earn that allowed rate of return only by sort of adhering to the requirements of their respective legislative authorities as exercised by their regulators, whether it's the federal or state level. And so, since they are cost-plus businesses, it's kind of good for everyone. What you don't want to see happen is politicians use that tool to just build a Rube Goldberg device because the costs will be passed along. The investors will get their 10% of return. And so the only people complaining is sort of individual, customers that don't really have a choice. That would be a bad outcome for everyone. But I have advocated for the state regulated utilities to be driving a lot of what you're asking about, because they can demand, if their legislators so, they have to legislate this because it's not part of the law today, and say, look, you're the methane that you either deliver through your pipes to your customers, or that you use, methane is the technical word for natural gas, or that you use to generate power, needs to have the following standards all the way back to the wellhead. And so those people selling to those utilities will have to perform, or they simply won't get the contract. And, those kinds of that. So sitting at the center of the energy system is these regulated power utilities that can have an enormous effect outside of their own footprint. And there's already evidence of that, because the vast majority of the wind and the solar that's been developed in this country is sold under 20 and 25-year contracts to state regulated utilities, to cooperative utilities and municipal utilities that all have this cost plus model. They have the ability by law to pass along all those costs to their customers. And by having that 25-year contract, they lower by more than half the cost of financing those projects, both on the equity and the debt side. And so there's a lot of wind and solar you wouldn't have if the buyer didn't have the balance sheet and the legislative ability to write that 20 to 25-year contract. That shows you the power that these companies have in affecting change upstream of their operations and upstream of their footprint.
Is the Biden admin's policies benefiting Quanta Services, Inc.?
To some degree it is. I think that the bigger change is the technological changes that have gone on. And you could say that we wouldn't have had the cost improvements in wind, solar, and batteries if the government didn't subsidize and kickstart them and have them benefit from what's known as Wright's Law. You can Google Wright's Law, it's WRIGHTS for your listeners. There's a lot of academic work behind this, unlike Moore's Law, which is kind of just something that Gordon Moore said, and since he's a genius, kind of most stuff that comes out of his mouth is usually right. But Wright's Law sort of describes the decline in cost of making a widget correlated with the cumulative number of widgets that you've produced. And so the lowering of those costs mean that you should, even though they're intermittent, you should probably include them in the power sector. Well, then if you're going to include them, you need to run more wires to them. And if they're direct current and you need to convert them to alternating current, well, then there's voltage issues and frequency issues. Remember, we run an alternating current system in this country. The machinery spins at 3,600 RPMs, which is 60 cycles a second. It flips from positive to negative 60 cycles a second. And if it gets a little bit out of phase, everything shuts down. And so there's a lot of capital that needs to be put to work to access this new lower cost forms of energy. And that was true of natural gas on the pipeline side, and it's true of electricity on the poles and wires side. And so Quanta, I happen to think, is a very well-run organization. When you go to their website, the thing that has to impress you is the first thing that they hit you with is their safety college in LaGrange, Texas. And when you talk to Duke Austin, who is the CEO, he is a fourth generation lineman. And he will tell you he's seen some things that he would prefer to be able to forget in terms of safety issues. Safety is first and foremost to this company. If you're a regulated utility, you cannot be seen to subcontract to someone that does not run a safe operation. And so what I really like about this company is their commitment to safety first. It tells you quality and safety matter the most, and then they will be a preferred provider to be putting in sort of, this additional capital that allows the grid to access cheaper forms of energy so that everybody benefits.
We had a question came in actually on my phone via text. I guess they wanted to keep it off the grid of the Zoom for some reason. Why isn't Brookfield Infrastructure Partnership one of your top holdings?
Yeah, we love the guys at Brookfield. What we never love is the accounting for the earnings. We are old school. We missed opportunities. We have owned various Brookfield securities over time. There was a group called Canadian Hydro, which is now Brookfield Renewable. It was all hydro in Canada before Brookfield bought it. They are very effective infrastructure investors. But there is this whole issue when you get into income securities where you start getting away from GAAP earnings and you start talking about distributable cash flow or free cash flow or economic earnings or whatever. And my suspicion antenna go right up when that happens. And so these are companies that generally are distributing way more than their GAAP accounting earnings. And they will give me, like everyone else, chapter and verse about why GAAP accounting doesn't apply to their company. And it's like, okay, I get it, but I still am having a hard time understanding, the distribution versus the actual earnings. But that's not to take away from them. We always take meetings with those guys at conferences because we always learn something. Hopefully they learn something from us as well. And they have been in the portfolio from time to time.
Makes sense, Jim. Is Bitcoin mining really hurting the environment?
I don't know. I read these articles. I know probably less about, crypto and Bitcoin than anyone on the planet. I try to stay focused on where I can make money. As a student of history, I think I understand money. Um, I took my capital markets class from Franco Modigliani at the Sloan School at MIT, right? And he
Oh,
taught
sure.
me, and so he taught me money is three things. It is a store of value, it is a medium of exchange, and it is a numeraire, meaning it is the sort of the scale by which things are measured. Um, but the other thing that money is, in a modern sense, is it's backed by the full faith and credit of an entire society. That is sort of how I think about Bitcoin. It's not a currency, it's a commodity. And so you can use commodities just like gold as a medium of exchange. You can use commodities just like tobacco leaves and gold as a numeraire, and you can believe that commodities are a store of value. So they have those elements, but in the modern world, and so I understand this energy intensity of mining of Bitcoin uses a lot of electricity, but there's a lot of things in the world of data that use a lot of electricity. And we haven't seen it in electricity demand because we have had this, I'm going to say one time, there may be others, but this shift to LED light bulbs has been an enormous step down in our electricity consumption, right? So an LED light bulb burns 15% of the energy to create the same amount of lumens, right? Because we talk about watts. Well, that's the energy going into the damn light bulb. It's not the lumens coming out. And so a lot of the incremental demand for electricity from all this data processing that we're using just to run our smartphones is being hidden by the efficiency of LEDs, of swapping out new air conditioners for old, especially since a lot of the air conditioners, the big growth in air conditioners is really sort of in the 1950s, 60s, and 70s. And all of that stuff is going through its replacement cycle. And so there's a couple of sort of big replacement cycles that are hiding the demand for that. And I've read some reports that think that when we're behind that, we're behind the air conditioner replacement, we're behind the LED replacement, that these underlying growth and demand are actually going to make electricity grow 1 or 2% a year, especially when you start talking about electrifying the transportation system. And so I got to think of it in that context.
Maybe two back-to-back questions on that. Is Tesla truly an energy storage company?
Well, I don't know if, I don't know. I don't have an earnings model of Tesla, so I'm not even sure where they make their money. How much is from cars and how much is from the batteries. But I think what everyone in that space is seeing is an enormous number of changes, and you have got to stick your finger in a lot of pots to make sure that this uncertain series of outcomes that's going to happen doesn't leave you behind. And if you can spend just a small portion of your profits or revenue sort of keeping a finger in these different technologies, whether it's storage at somebody's battery storage at somebody's house, or some kind of energy service business associated with that, is something that you ought to do. NextEra Energy is one of the best managed utilities in the portfolio. NextEra Energy and NextEra Partners, generally, if you combine them, is one of the largest, if not the largest position in most of our portfolios. They do a lot of small sort of side investing in small startup companies so that they can keep their eye on where all this stuff is going for a very small percentage of their profits. So I think it's, when you go through this kind of rapid technological change, if you can keep up with it by making very small investments that kind of get you inside the wall so you can actually see the economics as you're a shareholder, I think to me it's a worthwhile thing to do. I'd be the last person to say I know which technology is gonna work 20 years from now. I think that's a mug's game. But betting against technological change is one thing I will say. The people that bet against the engineers and the scientists,
They lose.
They always end up losing. Yeah, so I won't be one of them. I've learned that lesson. You just don't bet against these guys.
Electric vehicle mandates are rising towards 40% share by 2030. David, one of our live participants, sent in this question. Can the US grid meet the additional demand? And does it give the regulated utilities above trend earnings per share?
It helps on the cost absorption for the electric utility. So I'm going to answer that question first. Remember, they're cost plus businesses. And so the actual demand doesn't matter. Remember, so their profit is essentially, call it 10% times their book equity, or their regulatory book equity. And so whether demand is growing 1 or 2% or shrinking 1 or 2%, they still get their allowed rate of return. Remember, they're getting that in return. They're getting limits, if you will, on their profitability in return for having been granted a monopoly. Can the U.S. grid, build it? Absolutely. I really don't see the impediments from a capital standpoint of doing that. The only impediments are transmission, where you're going across somebody's property and crossing states. So the rights of eminent domain. Let me just kind of go through the list here. State regulated utilities within their states have the right of eminent domain. On an interstate basis, natural gas pipelines, which are regulated under the Natural Gas Act, have the right of eminent domain. So if you apply to the Federal Energy Regulatory Commission to build a pipeline and they grant you a certificate, that certificate comes with the right of eminent domain. An oil pipeline does not come with that, with that right of eminent domain. An interstate power transmission line does not come with that right of eminent domain. And so one of the things that has been addressed, we have not seen the language in the infrastructure bill, is changes to the permitting of interstate power transmission. Because remember, within the state, the state has the right of eminent domain. It's crossing states. If I have an interstate power transmission line, the Federal Power Act, if I get a certificate from the Federal Energy Regulatory Commission under the Federal Power Act, it does not give me the right of eminent domain. I have to piece together those pieces of property myself, unless each segment of it is granted the right of eminent domain by the states. And if they're not cooperating, then it doesn't happen. So that's sort of that is a real sticking point. People have said it takes 10 years in many cases to get an interstate power transmission line built. And I was asked to testify in front of the Senate 3 years ago, and this is one of the questions they were asking about, should we change the permitting process? And I don't know if I answered it verbally or in my written testimony, but the idea that the federal government should start strong arming local resistance to this stuff is sort of violates sort of the principle of our federalist system, and B, I think it would backfire anyway, because they're going to get challenged in court. And one of the things that every president learns the hard way is how hard it is to implement things in our federalist system. Because you say, well, I got Congress on my side, I'm going to do all this stuff, and it's like, good luck. If the states are against you, it's not going to happen. You have to gain that cooperation. So that is the biggest friction. That's one of the bigger frictions. Providing capital and allowing these companies to get a rate of return is actually the easy part of the equation on building out the grid.
How does blue and green hydrogen play into this?
So the way I think people should think about hydrogen is energy storage, not an energy source. And the reason is because you can't mine hydrogen. It's always linked to another atom, like, I don't know, water. And so it takes energy to separate them. And so the energy you put in is actually going to be more than the energy you take out. And so the reason you do it is because A, you need hydrogen for an industrial process, or B, you need hydrogen as a storage device because it is cheaper, say, than a battery. And this is where you sort of get into the economics of batteries, which is one of the more misunderstood parts of the evolving energy system. If you're running solar panels, and you're charging a battery every day and discharging that battery later in the evening when the sun goes down and people get home and turn on their appliances, that battery is being cycled 365 days a year and has a very low competitive cost. Solar plus batteries is competitive relative to the wholesale price of electricity, which is a competitive market. Mm-hmm. It's seasonal storage that is not even close to being economic, and probably for batteries, for lithium-ion batteries, never will, meaning that there will always be something cheaper. Hydrogen is cheaper than lithium-ion batteries. So if you think about it, if that windmill is spinning at night when no one needs the electricity, why not just let that windmill separate hydrogen from oxygen And that is a cheaper way to store energy than building an
For
entire
sure.
battery of lithium ion batteries, et cetera, et cetera. And so that's how people should think about hydrogen, recognizing that the existing infrastructure likes to use gaseous and liquid fuels that combust to drive turbines. And so remember, if you can use the existing infrastructure, you have saved yourself a lot of money, but by separating hydrogen from oxygen, you're spending a lot of money. So that's again why you should be mandating outcomes, not solutions, and let the really smart people out there come up with the cheapest way of achieving it. That's how I think people should think about hydrogen. And
Jim,
and if you're going to invest in hydrogen, understand you're investing in a commodity, and all that matters is cost. Because there is no, hydrogen is hydrogen, it's an atom, they're all the same. There's no product differentiation in a commodity, right? So
I'm going to go a little off topic for a second, but then loop it back in. Some of the work that I do with families is assessing their internal sovereign risk and helping them to mitigate that, often by becoming to some degree more global. I have grave concerns. I hope you could tell me they're overblown, but they're probably not. Here in the US, relative to the infrastructure and capability of our electrical grid. If I was a bad nation state, looking at cyber attacking and other attacks to our grid, I think is a grave concern. I heard General, who I'm a big fan of, Stanley McChrystal, on Tim Ferriss's show, talk about that. I think in the short term, he thinks that's like the number one thing. Because think of it, you lose electricity in greater New York for, forget weeks, I'm going to say 3 to 5 days. I think you have closed banks, people can't access their crypto, supply chains, food and water. I think you have mini chaos.
Yeah, so in answering your question, I want to take a brief detour and just talk about reliability and resiliency. When a utility makes an investment in reliability and resiliency, that investment should be bumped up against the savings to the GDP or the economy as a whole in their footprint for avoiding the outages that you're talking about. So whether the outage is caused by a tornado or hurricane or a foreign enemy or domestic enemy, doesn't negate the fact that the world every year that goes by is more and more dependent on a reliable electric system. So, look, when I was a kid, when you were a kid, when the lights went out, it was a chance to read a book by candlelight and to get the family around the kitchen table and play Monopoly by candlelight. It wasn't that big of a deal. Today, business is shut down.
Yes,
so
for sure.
So Florida Power and Light, for example, will tell you that in their footprint, every day their system is down, footprint wide, costs the Florida GDP $1 billion, $1 billion a day. But just the fact that they know what that number is informs both them and the regulator that if they spend $1 billion, you could have a 1-year payback. Because how many times has a hurricane hit the Florida Power and Light footprint? Pretty much every year. And so, so whether or not it's a national security threat or it's simply a natural threat, meaning that just like, when you look at the statistics of the damage from hurricanes, the dollar numbers go up. And when you look at the studies, all the studies conclude the same thing. The dollars are going up because there's more buildings and things to knock down. There's no evidence that if we didn't have those buildings 100 years ago, the cost would have been the same. And so, because we have temperature data going back 200 years, we don't have wind speed and frequency and that kind of stuff going back 200 years. And so even short of, in terms of getting things done, I always think of who the constituencies are. There's always a national security constituency. There is a business roundtable. It's like those guys say, hey, look, this is my business. We should make the grid more reliable. There's always an equity issue. It's like who suffers more when the electricity goes out, right? And so I think short of the national security threat, there is an increasing justification for making the grid more resilient. One of the things that's pushing us in the right direction here is technology, and that is that the electric system we have today is nothing more than a bigger, more sophisticated version of what we had in Thomas Edison's day. It's a giant radial system, and I was a straight A student in science, and I always had to explain to my students on how things work. Electricity is very hard for people to understand because they can't see it. So the best way to understand electricity is water. And so the way I explain voltage is sort of the height of the waterfall, and the way I explain current, it's the volume of the water going over the waterfall. And so if you drive into a town in the Midwest, the first thing you see is the water tower. That water tower holds pressure, so that the electricity goes out, the water goes to where it's asked for. That is how the electricity system works. You have giant power plants. The electricity flows out, not because it's sent out, but because it's asked for. Turning on a switch has the same effect of electricity as opening your faucet. The pressure is in effect right behind the wire. So it's a one-way system that is pretty dumb. And so it's over-engineered with a lot of steel. That system is becoming bidirectional and more intelligent and more dispersed. That makes it harder to damage from an electronic magnetic pulse. I mean, just think Don Cheadle, Ocean's 11, how did they get into the thing? He shut the electricity, system down in Las Vegas for 3 or 4 seconds so that they could get in there. So George Clooney could get down the shaft, and, lasers went out. So that's the thing these guys are talking about. If the grid is one giant interconnected system, you can bring the whole thing down. And the more dispersed it is, the better off we are. And we're going more dispersed, not because of national security, but because technology is allowing us to pick up cheaper, more distributed sources of energy, because we have the technology and because we have the data capability to handle all the information that it takes to run a bidirectional system rather than a dumb, over-engineered, steel-heavy radial system. But so far, there had been very little in the way of mandates to make our power grid more resilient to that kind of attack. We talk about it a lot, but again, investing in all these state-regulated utilities, there really isn't much happening in terms of dollars. It would say it's a big redesign of the system, but it's happening for other reasons now. So
we're doing this interview on October 6th of 2021. Would you like to guesstimate by the end of year end the price of a barrel of oil?
No, mug's game. Don't do it. There's been, there's a lot of factors that have come together for oil and natural gas prices, some of which are temporary and will reverse, others that aren't. And so, you look at what's going on in Europe, there have been steady declines in North Sea production. There has been steady declines in the biggest onshore field, which is called the Groningen field in the Netherlands. It used to be you go back 40 years, it was a huge percentage of Europe's natural gas supply. They determined a few years ago that it was the continuing to draw down at a certain rate, this field was creating seismic activity, so they lowered the rate of production. All of those things have been in the background. You combine that with short-term weather issues, the Suez Canal crisis, the normal logistics problems of getting drivers and employees, sort of laying people off and deferring capital spending in the heat of the pandemic, and then trying to get those people back. It's affecting the supply system everywhere. All of those things affect the energy system as well. Some will reverse and some won't. I would point people to the fact that when you look at the capital spending for the publicly traded companies, because that's where you get the data, and they are a big part of the world's oil production. Remember that a lot of the state oil companies, while they don't report their numbers, they're in partnership with Exxon and Chevron, right? So what Exxon and Chevron are doing, they may only own 20% of that field, but their volume is reflecting the other 80%. And so when you look at their capital spending and compare it to their asset base, right? For the first time in 30 years, and probably if you could get the data, the first time since World War II, the capital base of these companies is shrinking. And the way I measure that is real simple. It's capital spending minus depreciation, depletion, and amortization, all divided by the asset base. And if you go back over 30 years, that number has ranged between 3% growth and 12% growth. In other words, in the last 30 years, the industry has always been growing its capital base. Over the last couple of years, that number has gone negative. It's minus negative 6% now. And so the response to these higher prices is going to be muted. The chairman of Chevron said in an interview, probably it was last week, he said, look, I look for two signals to determine whether I should spend more capital. One is the price of the commodity, which is giving me that signal. And the other is our shareholders, which are telling me not to spend. They're telling me to keep capital spending below depreciation and use the free cash flow to buy back stock. And the question is, why is he getting that from shareholders? And I think the answer is twofold. The first one is, in the last cycle, these guys wasted capital. When I mean waste capital, I'm talking nuclear weapon scale. Okay, so I used to speak every year for like 15, 20 years at the John S. Harrell conference, which was held in Greenwich. Art Smith, who owned that business, bought it from John S. Harrell. It was a consultancy to the energy business, and he'd have a buy-side investor panel. I got there and say the same thing every year. Now I try to make it interesting and funny, because as Oscar Wilde said, if you're going to tell the truth, make it funny, otherwise they'll kill you. And I would stand up in front of that industry and I would say, you guys basically suck at investing capital. You should just do less of it. So that is much more evident to shareholders after a big spending boom like we've been through, because obviously oil prices went up over $100, and of course they spent all that money, and the returns were absolutely horrible or negative. And so the regular shareholders want them to do that. And now the ESG shareholders, the ones that believe not in divestment, but the ones that believe in engagement, and we can talk about that, because if your approach to ESG is simply not owning a fossil fuel company because they are the source of all carbon, well then you're not affecting how the company is run because you don't have a seat at the table. And that's much more of a European approach. In the US, there's this whole move towards engagement where the only way you can affect outcomes is to have a seat at the table, and you can't have a seat at the table unless you own shares. And this is how engine number one was able to replace 3 of the board members at Exxon. It wasn't just the ESG engagement shareholders, it was the conventional regular guys that said, hey, we need to change, they're wasting capital. And so it's a very powerful sort of part of the cycle that has, for the first time in history, this, you really should spend less on oil and gas because it should go away over time, and either give the money back to us or demonstrate to us that you know how to do something in clean energy with that money. And so that is going to be a muted response, I think, to this price signal.
I do want to be respectful of your time. I have 2 final, I would call them quick questions, and we'll go right to a close. I believe you invest in regulated utility companies running pipelines and electrical power assets. How do these companies grow when demand for growth, if my research is right, which means it's probably not, is less than 1%?
No, that's dead on right. That's the biggest confusion that people have when they don't understand sort of the utility space. Now, if you look at the average growth of the Philadelphia Utility Index, it's only 3, 4, 5% over the last 20 years. But that's the average, right? And inside that average are non-utility businesses that have been shrinking for the last 15 years, merchant energy businesses, energy trading that lost money, all kinds of things. Because after we deregulated electric power generation in this country, a bunch of the utilities had half of their assets in a cyclical declining merchant business and the other half in poles and wires. The average investor has no idea which those companies are. But if you could just invest in the regulated part of the pipeline companies and the power companies, which is how we construct the portfolio, and you know their capital growth plans, you can get above average growth. And you say, but they're still stuck with the 1% electricity, and I don't understand how they can grow 7%. And the answer is that they're laying capital down on the ground to access cheaper sources of energy. And so think about, I mean, the best analogy is China. I mean, what's happened in China in the last 30 years is you built trillions of dollars of infrastructure to access cheap labor, right? Because, oh, you got all this cheap labor in China. Great. How are you going to capture the value of that cheap labor? You got to build a factory and a supply chain all the way back, from the factory all the way to the consumer. And you say, well, I've got this new cheap natural gas. How do I make electricity from it? Well, you got to build a new pipeline. Maybe you got to build a new power plant, and you got to string new wires, because unless the coal plant voluntarily shuts down and lets you use their land, which they're not going to do, you're going to have to put a new footprint up. It's going to need new wires. So the simplest way to explain it is that they have actually lowered, in real terms, electric power prices to the retail customer in this country are flat to down in real terms, especially if you pull out a couple of states, it's down for the US as a whole. And they've done that by investing capital to access cheaper energy so that the total cost in real terms has actually gone down. So everybody's better off. And so that's why technology and technological improvement is so important for consumers in the energy transition, and why, if you're an electric utility, you're not at risk for technological failure. If you pick the wrong electric vehicle company, the wrong battery company, the wrong fuel cell company, then they have the wrong technology, then as an investor, you're going to lose pretty much everything. The network utilities can wait to see who has the better product and then make a 10% return on the capital that they put on the ground, hooking you up to that supply. So whether that supply is coming from the consumer himself with solar panels on his roof or his building or whatever, or it's what we call demand response. It's the software and hardware that allows that customer, usually a big industrial or commercial customer, to shut off some of their demand for electricity at 4 p.m. while all the air conditioners are running, because they can go without that electricity to run that part of their plant for 45 minutes. Electricity is expensive. Why not do that? All of that capability is brought to you by the people that operate the grid. And the only people that are allowed to do it are the ones that have been granted a monopoly. No one else is allowed to come in and manage that grid, because if it doesn't have the exact right frequency and the exact right voltage, the whole system crashes.
I believe my last question, conventional energy stocks have started to outperform technology stocks. Why?
So we did a blog on this actually just late last week. So if you just go to our website, EIPinvestments.com, we said it was FANG versus FANG, right? And so there's actually an oil producer called Diamondback Energy whose ticker is FANG, and so we just thought it would catch people's attention. And so the byline I put on my LinkedIn page was how do oil companies in a non-growth industry outperform growth stocks by trying not to grow. I mean, what you have to love, you go to an energy conference, it's 3 days. The person who speaks first is the energy economist, right? And he gives you all this data and everything. And the conclusion is what you said before. Energy demand is going to grow about 1% a year, even though world GDP is going to grow 3% a year, right? Then for the next 3 days, every energy company gets up and tells you they're going to grow their production somewhere between 3 and 5%. Okay, somebody's wrong. Either someone's not going to grow 3 to 5%, or they're not going to get a return on capital, or that energy economist is wrong with his 1%. And so, this is the issue you face when you're an oil investor. The only time to buy these companies is when they're in a bunker mentality. They're afraid to put the money back in the ground, as they should be, because they're technically brilliant. What these guys have accomplished downhole, just go to an offshore oil platform. I mean, it's a technological marvel. But don't ask these guys to allocate capital from your life savings. That's not their core skill set. They're engineers. And so if you give them the money with bad corporate governance, you're not going to get it back. They put $1 in the ground and 50 cents comes back out. And so that's why, and again, these are not long-term investments. These are trades. When I used to speak every year at the Herald's conference with a guy who ran a hedge fund, and his quip was, okay, in the world of energy, Shell and Exxon are investments, everything else is a trade. And I always thought that was a great quip because it was essentially true. And so understand that conventional energy has lower earnings today than it did 20 years ago. And, and oil prices are higher than they were 20 years ago. So these guys are not good at allocating capital. And so when they're not allocating capital is when maybe you have the tailwinds to a trade. And if you say, well, that's not good for pipeline companies, you say, well, pipeline guys are the same way. The best returns for crude oil pipelines was actually when oil production was shrinking in the United States. And you say, well, that just doesn't make sense. You say, again, let's go back to how you make money. You make yield, you make money from the yield and the capital appreciation, right? And what can destroy capital appreciation in any commodity business, even if it's a monopoly pipeline on a 10-year contract, is the construction of too many pipelines. And so when oil production is shrinking 1 or 2% a year, who in their right mind is going to build a new oil pipeline? Nobody. So if you're running a pipe operation, there's all these little investments that are debottleneck here because a new airport goes in over there and a new field gets put over here, and you get inflation escalators on your tariffs, and you got a yield, and you got a nice low double-digit return bring in the shale revolution, and all of a sudden your per share returns go down because everyone is throwing money at pipelines. So what's going on in the upstream business, which is this capital discipline as a result of the cycle and perhaps ESG investing in a changeover in who's on the board of directors, that mentality then, of course, translates to the pipeline business, because if you don't see runaway production growth, then you're not going to be building new pipelines. And that allows you to then harvest the value of the assets you have. These are mature businesses. And so, don't think these are growth investments. And when the management thinks it's a growth investment, put your hand on your wallet, stand up, and walk out of the room.
What a great way to end. Everyone, we've been very fortunate to interview Jim Murchie, that's Murchie, co-founder of Energy Income Partners, probably better known by their acronym EIP. Jim, for those that are, I guess, qualified and may have an interest in learning more, should they simply go to the website? Is there someone from your firm that you could give an email? What would be the best way?
Just go to eipinvestments.com. If you just Google EIP investments, it'll come up. And then what the website will ask you to do is to attest as an accredited or qualified investor, and we can send you all the materials. But all of the blog posts and everything is in front of that firewall, in front of that, we call it paywall, but you know what it is, it's a security wall for qualified investors. And so you can get our information that way. But that's the easiest way to do it. And if you're interested in our investment partnership, which is really the most efficient way to invest in what we do, then that's the way to do it. You have to attest as accredited or qualified, and you can just do that by going to the website.
That does make sense. And I see, since we started talking and it was relatively sunny skies, me and Jim are both based about 5 miles apart in Little, Connecticut. It has gotten darker outside, Jim.
Gotten darker, yeah. Luckily, the lights have not gone out. We have a reliable system here, but
you beat me to the punch about the electricity.
Yeah. It's a good thing.
I'll give a very brief close on my end. Everyone, I'm Angelo Robles, founder at Family Office Association and host of the Angelo Robles podcast. Check us out at familyofficeassociation.com. You could email me at angelo@familyofficeassociation.com. And please follow me on social media. I'm actually very busy on it. Our main platform, mainly for our interviews, is YouTube, and simply we're Family Office. Go to it, you'll find it. All good. Thank you to our live audience, those that watch and listen. And Jim, thank you so much for your time.
Thanks for having me. It was a lot of fun.
My pleasure. Thank you.